All right, guys, let's talk about SOFI potentially joining the S&P, what it means for the stock, what it doesn't mean for the stock, which is probably just as important. And I'll give you my honest opinion on this, and some of you guys aren't gonna like it. And all the different things around it, because there is tons of misinformation out there that you guys have to understand, or else it's going to get you really, really destroyed as an investor. And I don't want you guys to be in that spot. So make sure you like the video if you like getting the truth out the hype, because that's exactly what you're going to get today, guys. And unfortunately for some folks, it's going to be a little bit disappointing, but that is all part of the process of investing and becoming a good long-term investor here. And remember, that's the angle I'm taking. That's how I'm viewing this. And that is the approach that I'm using. If you're talking about day trading or swing trading or something else, doesn't apply here, guys. I'm talking specifically about long-term buy and hold investing. So what does SOFI joining the S&P not do? Let's discuss those first. The first thing it doesn't do is improve the fundamentals. Despite all the different narratives you will hear about SOFI and why it's so great for SOFI, the reality is joining the S&P provides you no revenue. The S&P is not paying SOFI to jump in there, right? EPS isn't going to get better, right? There's not more sales coming SOFI's way. They're not doing more loans because of the S&P. Profits don't magically go up from that. All of a sudden, new members aren't signing up for that. New members aren't signing up for more products because they join the S&P. None of those things happen when SOFI is added to the S&P. Absolutely none of them. There's nothing that changes with the fundamentals at all. You have to keep that in mind. People talk about all these different things and it means this and it means that, and it's simply not true. There is no revenue. There is no more profits. The business doesn't get better. Nothing happens to the fundamentals at all whatsoever. Now, I'm not saying it's bad. I'm not saying that at all, but you've got to learn to distinguish good from bad, from actual things that hit the bottom line, actual things that impact revenue, EPS, and all those other good things like that versus just things that are cool per se. And unfortunately, joining the S&P doesn't provide revenue or anything else fundamental. The second thing it doesn't do is eliminate volatility. I've heard it personally. Actually, it was sent to me. I guess I didn't hear it personally, but some group members actually sent it to me that, hey, SOFI joins the S&P, all the volatility is going to go out of the stock. That is simply not true at all, guys. You don't go from highly volatile over here to all of a sudden no volatility whatsoever. That is not how that works at all. I wish that it worked that way. I wish it was as awesome as just, it's a great company. Everybody loves it. Everybody agrees it's a great company. Therefore, it's not going to have any volatility. It's just all going to go away. It is simply not true, guys. We'll talk more about volatility here in just a second. But in regards to the volatility going away, it is not going to happen, guys. I would not be surprised if we get a significant downturn, let's say end of this year, next year, whatever the case is. Whenever we have our next correction or crash, guess what? It's going to crash too. It's not going to sit strong like Apple did this past time during the crash or correction, or like McDonald's did during that time, or whatever the case was like that. Sorry, it's not that kind of stock. It's probably not going to be that type stock for a very, 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 very long time. So joining the S&P does not create a scenario where all of a sudden the volatility goes away. And the last thing, it doesn't add to the share price long term. All right, I know this one right here is going to be controversial because everybody says, oh my gosh, look, you join the S&P and then everybody has to buy you and then the stock goes up. Yes, guys, typically good companies are getting into the S&P. I would agree there. Typically, it means you've been doing really well quarter in and quarter out, exactly like SOFI's done, and you've had a corresponding rise in the stock. Yes, I would also agree that in terms of the short term, might very well, push the stock price higher. Absolutely. But joining the S&P doesn't make you go from a 30 multiple or a 50 multiple to a 100 multiple because, well, now you're in the S&P, so now you get a higher multiple because you're in the S&P. It is not how it works at all, but yet that is exactly how it gets positioned all the time is, oh my gosh, you want to buy before the S&P inclusion because it's just going to the moon after that. Well, usually the stock is already on a run, right? And whatever, this is just another thing that happens to hit that traders will come in and play trading games with. I would agree there. But there are a lot of stocks that do have a bump up after the S&P inclusion and they actually crater down. Sometimes you're just a product of a bigger market drawdown or something of that nature whenever you're added. Sometimes you're already on such a ridiculous run coming into it, they just decide to trade you down. And other times, of course, the stock price does go up, but those are short term. I'm talking about long-term sustainable jumps up in the stock. Typically you see a stock and everybody always draws the same conclusion. Oh, I'm going to go look at this stock. I'm going to look right there on the S&P date and then see what the stock did afterwards. Well, if they were crushing in earnings quarter in, quarter out, quarter in, quarter out, of course it's going to continue to go up. Was it the S&P that caused that? Or was it the earnings that caused that? Was it a hot market that caused that? Or was it the S&P inclusion that caused that? That right there is where people are conflating, correlation with causation. and you can't do that as an investor. It does not add anything to the long-term price. You do not get a higher multiple because you're in the S&P. It's just simply not how it works. It comes down to the business, how the business performs. And typically when somebody is newly added to the S&P, typically, not every time, but typically they've been crushing it on earnings, crushing it on, Wall Street as well. Wall Street's behind the stock, the momentum's in their favor, and therefore they get added. But I can guarantee you, you get added to the S&P, then you have terrible earnings. Your stock price isn't going up because you got added to the S&P, guys. It's just not how it works in the end. But let's talk about what it does do for SOFI by getting added to the S&P, because there are some things that are great for SOFI that do happen whenever you get added. So let's discuss those next. So first up, it accelerates the process of moving from trader controlled to institutional controlled. Now, in the end, guys, this happens over the course of years, but in the end, you want your stocks to eventually move from trader controlled over here to institutional controlled, because it does create a stable investor base for the stock. It does create where the quote unquote big whales that we always hear about, it makes it to where they want to own your stock. A lot of times they don't even look at a stock until it actually is in the S&P. And then sometimes they're even like, yeah, we wait until you're in the S&P for 2 years before we even look at the stock. Depends on each institution. Each one of them is different. But obviously there's the initial institutions that have to come in and buy for all the index funds and all the other things of that nature, where they just have to own everything that's in the S&P, for example. So you have all those players that come in. But as the years churn on, more and more institutional players will come into the stock. And a lot of them use S&P 500 as a screener for, hey, we don't buy anything that's not in the S&P 500. Great. That means those folks are now interested in the stock. Doesn't mean they're immediately going to pile in right on S&P day, like a lot of folks will position out there, but it absolutely accelerates that process of moving from that trader controlled over here to that institutional control, which leads perfectly into the second one, which is it lowers volatility. Now, notice I didn't say get rid of volatility. I just said it lowers the volatility. As you make that journey over the course of years from trader controlled to institutional controlled, you get less and less volatile as you kind of move forward in that journey. Obviously, there are exceptions to that. See Tesla for that. But generally speaking, your volatility tends to slow down once you hit the S&P and as you kind of work through that process of more and more of those institutional controlled folks coming in. That doesn't mean no volatility. It doesn't mean if we have a large drawdown, we're not going to see, SOFI cut in half. Doesn't mean any of those things. But it does mean lower volatility than it would have if it wasn't in the S&P 500. That right there is one of the big advantages that you get as an investor. And the third one, it gives a stable base of investors. I know I kind of alluded to it before, but it gives you a stable, solid base of investors. This is where you tend to get those more long-term buy and hold investors buying the stock and less hedge funds playing hedge fund games with the stock. S&P inclusion gives you that. We talked about that with those large institutions that start buying it. You start to get that stable base of investors as you kind of hit these wickets, which is kind of it's almost like they use the S&P as like a screener for stocks. There's thousands of stocks out there for them to choose. They're not going to chase them all down. They're just going to simply look at the 500 in the S&P and kind of move forward from there. And obviously they've already done their work on all the rest of the S&P. So when, 2, 3, 4 stocks, however many are added this time around, then they're taking a look at those 3 or 4 stocks and deciding whether or not they want to add it to their stable base within their funds that they control. And of course, you're going to get a stable base because the other funds that just simply hold the S&P 500, they don't really do a whole lot of in and out trading, things of that nature. Yes, they rebalance from time to time, but it's not actively trading like a lot of the hedge funds do. So it turns your investor base to a more stable base of investors. So what is my opinion on this? Guys, I'm going to be perfectly honest here, and it's going to, make some of you guys a little bit upset, and that's okay. I couldn't care less about getting added, not added, whatever the case is. I don't track it. I don't watch it. And I quite honestly don't care. And here's why. Because a great company, it's going to happen sooner or later. There's no point in trying to guess it. I'm not trading it here at all. So I don't see the point in tracking it. Now, if you're trading and you're playing a trading game, might very well make sense. But I am far more concerned, and I care about earnings and the company's execution. That's what matters to me. I could care less if it's added to the S&P or I don't know, whatever this index and that index or whatever the case. Sure, they're nice for the reasons I just talked about here. But I'm talking about my personal investing right here. That doesn't weigh into the decision. I'm not sitting around going, ooh, should I add it before the S&P or should I add it after the S&P or what do I think about? No, I'm doing it based upon valuation, my plan, and how their performance has been on earnings, and whether or not it fits my price target and everything else that I'm doing in regards as an investor. The rest of it to me is simply noise, silliness. It makes for great clickable videos, great clickable articles, gets people all excited. all these other things like that. And for me, that's not helpful with my investing at all. I care about the fundamentals. I care about the execution. I care about what happens on earnings. The rest of that sort of stuff, it's a nice to have. It's a cherry on top, whatever the case is, for the reasons we just discussed. But beyond that, it adds nothing fundamentally to the stock. It doesn't help out any with earnings. It doesn't help the company execute better or anything of that nature. So for me, definitely something I really don't care about. I'm not tracking it. I'm not looking at it. They're going to get in sooner or later. When? Who knows? A lot of people have been guessing it's going to get in for over a year now. Still hasn't happened yet. Will they get in? Yes, it will eventually happen. When? I don't know, and I don't care. Great whenever it happens. It'll be a blip on the radar for myself. I'm going to continue to execute to my plan and wait for Wall Street to get stupid against the stock because they've been executing so well. I just simply want to buy more of this stock in the end. So if you want to learn how to focus on those fundamentals and kind of ignore a lot of the other narratives that are out there in YouTube land and on X and everywhere else, all over Wall Street, all other good stuff like that, and you want to work directly with me to do that, check out the pinned comment down there. I may have left something special for those of you guys that made it this long in the video. If you want to learn that through free courses, through free coaching, through the best 6, 7, and 8-figure Discord out there. Guys, there's so much involved in the group. Check out the pinned comment, see if a membership's right for you. And click this video here if you want to see exactly what I'm buying in this market. And click here to see my exact plan for this market. So thanks for watching, and we'll see you in the next one.